Hello, my name is John Hopkins. I'm a partner at Prospect Financial Solutions in Redlands, California. Taxpayers typically have questions about what they can or cannot deduct, and also they have questions about whether or not it even makes sense to deduct certain things. So this video and the slides that we put together are hopefully going to answer a lot of those questions and then also help you compile your numbers so that we can smoothly and properly file your annual income tax return. So over to our slideshow, the Schedule A. First, some basics about the Schedule A. The Schedule A is a personal income tax form. It is not business related. When we think of the Schedule A, as far as terminology go, we also can interchange that with itemizing deductions or itemized deductions. And the Schedule A is a form that gets attached to your annual Form 1040. There's a spot for it on the Form 1040, and the Schedule A gets filed behind it. We have to distinguish between standard deduction and then versus the itemized deduction. So every taxpayer receives a standard deduction. And for 2022, we have these amounts listed here. For if you're a single tax filer, you get a $12,950 standard deduction, head of household $19,400, or married filing joint $25,900. Now, if your itemized deductions add up to be higher than your standard deduction, then we file the Schedule A with all of your itemized deductions on there. We don't file a Schedule A if you don't have itemized deductions that are higher than this. The main itemized deductions we have listed here: medical expenses, state taxes, property taxes, DMVs. So that's what we call the SALT deduction, state and local tax deduction, home mortgage interest on your primary residence, charitable contribution, and gambling losses. So even though you may not have deductions to itemize on your federal income tax return, you might benefit from claiming the deductions on your state tax return. So we have a lot of clients that will not itemize their deductions with the IRS, but they do with the state of California. And that is because if we go back to this slide, this is the IRS standard deduction. You can see the amounts there. If we look at the California standard deductions, they're much lower. So it's an easier threshold to get over. We're located in California. This varies by state. Some states do not have, or they have a lower standard deduction, they may have a higher, or they just comply with the federal standard deduction. Medical expenses. You can only deduct medical expenses that exceed 7.5% of your income. We could explain that a little bit with this example. So suppose you have $100,000 of income and you have medical expenses of $8,000. You're allowed a medical deduction of $500. And you can see the equation there. 8,000 minus 7,500 is 500. Some basic medical expenses that you may deduct include insurance premiums, unless they are pre-tax through your W-2, through your job, co-pays, hospital fees, labs, x-rays, prescriptions, dental and vision expenses, long-term care. You need to talk to us about that, and medical mileage. Now there's a long list of additional medical expenses that you're able to deduct. So if you have something that you think would be deductible, make sure you ask us, but these are the common ones. House deductions. You are allowed to deduct mortgage interest. Your loan holder should provide you with a Form 1098, and that's going to report all of the interest on that form that we can put on the return. And keep in mind, you might get more than one 1098 if your loan was refinanced or transferred to another bank. Property taxes on your primary residence are an income tax deduction, and usually those get reported on a Form 1098 if you paid them through your mortgage. If not, you'll have to track down how much you paid. And you have property taxes, you deduct the payments when you actually paid them, not when they were due. So you look what payments were paid between January and December, and that's what you get to deduct in that year. Now, if you purchased, sold, or refinanced a property, there may be some itemized deductions on the closing document. So it's always a good idea to include this closing document with your tax documents when you upload them to our portal or bring them to our office. Charitable contributions. So any gift by cash, check, credit card to a bona fide charitable organization can be deducted. If you donated more than $250, you're required to have a receipt in order to claim the deduction. And the charitable organization is actually required by law to give you a receipt. Deductions for donations to Goodwill or Salvation Army are also tax deductible. And if you are going to deduct more than $500 there's a little bit more that needs to be reported. If it's $500 or less, we usually just put that on the return. If it's more than $500, there's an additional form that needs to get filled out. So be sure to always, when you donate, to get these receipts, write information down on them so that you can have those ready for tax time. On our website, there's a worksheet that we have that helps with compiling all of the information that we just covered. So if you aren't sure if you're going to benefit from itemizing your deductions, it's a good idea to fill out this PDF and give it to us and let us make that determination. Because, like I said earlier in the slideshow, you could itemize for the state, but not for the IRS. So the resources that we have, you can go to prospecttax.com and or prospecttax.com/tax process, and you can barely read this here. I'll have all of these links in the description of the video. You can go to prospecttax.com/schedule A, and that's where this video will be, and some other frequently asked questions as well as the worksheet. Thank you. Please like and share this video and subscribe to our channel. Have a great day.